In this video, I'm going to talk about cryptocurrency taxes in Germany. I'll share how is crypto taxed in Germany, how is it calculated, the tax-free threshold and loss adjustment. And don't forget to watch till the end as I will also share how to file your crypto taxes in Germany. By the way, if you're new here, my name is Essen and on this channel we discuss how to build wealth in Germany. I know talking about taxes is always complicated, and when it comes to taxes on cryptocurrency, it becomes even more complicated. But I will try to keep things as simple as possible. Alright, firstly, crypto taxes in Germany right now are based on the income tax law and the taxes are applied at your individual tax rate. So it can be up to 45% of your profits. And depending on your personal situation, solidarity surcharge and church tax may apply also. So how exactly can you calculate the profits? To do that, you simply take the selling price and subtract your buying price, and also subtract any exchange fees that took place during both the buying and selling process. For example, you bought 100 euros worth of Bitcoin and the exchange fee was 1 euro, along with a 1 euro credit card fee if you bought using a credit card. You sold it for 120 euros, but again the sale included a 2 euro transaction fee. So here your profit could be about 18 euros. So now the tax would apply at this value. This is pretty simple, but this doesn't exactly happen like that, as many people buy crypto at various intervals and you cannot distinguish between these purchases if you bought 100 euros worth of crypto 5 times and then later on sold a small amount. Here different methods can become relevant. Ideally, you identify the exact crypto unit that you sold, but if this is not possible, the tax authorities generally use FIFO, which means first in, first out. With FIFO, you are saying that whichever cryptocurrency you are selling is the first one that you bought. Let me explain. If you bought 100 euros worth of Bitcoin at 3 different intervals, that 300 euros worth of Bitcoin has now increased in value. And now you want to sell 100 euros worth from this new amount. Under FIFO, the first Bitcoin you bought would be treated as the first Bitcoin you sold. In many cases, FIFO can be useful because of the 1-year holding period rule for crypto. At the time of making this video, in Germany, if you hold a cryptocurrency for more than a year and then sell it, the profit on it is going to be tax-free. But there are discussions going on to change the rule. So if anything changes, I'll put the details in the pinned comment. Now going back to our example, if one of our orders is older than 12 months, then under the right documentation and method, this part can be tax-free. But be careful, you cannot simply choose any old crypto from your whole portfolio and say this is the one you sold. The method is applied wallet by wallet and asset by asset. And once you use a method for a wallet, you should keep it consistent. One thing you can do here is that you can have separate exchanges or wallets for your long-term and short-term trades. This can make documentation much easier. Okay, now you know how much taxes you need to pay, but selling cryptocurrencies isn't the only time where taxes are applicable. Taxes are applicable each time a taxable event occurs. So what are these taxable events? The first one is selling crypto against fiat currency. As I mentioned before, if you bought some crypto and have sold it against a fiat like euro, dollar, etc. within a year at a higher price, this profit would be taxable. It doesn't matter if you transfer the profit to your bank, keep it on the exchange or move it to another exchange. Another taxable event would be converting from one crypto to another. For example, if you convert from Bitcoin to Ethereum and a profit was involved, meaning that you bought the Bitcoin at let's say 50,000 euros and now at the time of the conversion it is worth 70,000 euros. This conversion would be taxable even if you don't sell the Ethereum. Next taxable event would be if you buy anything with your crypto. When I say buying, I mean anything. Software, computer hardware, even if you buy a burger with your Bitcoin, this can be a taxable event. If at the time of buying the burger, the value of your Bitcoin was higher than when you originally bought it. What isn't a taxable event is holding your cryptocurrency, moving it from one exchange to another, moving it to a hot wallet or a cold wallet, or the other way around. These things are not taxable events. Next comes staking. Putting your crypto into staking is generally not a taxable event, but earning staking rewards is generally taxable when you receive them. In Germany, passive staking rewards are usually treated as other income under the following law, and the value is calculated using the market value at the time you receive the reward. If you later sell the staking rewards, then a separate tax question can come up again. These rewards are considered acquired when you receive them. So if you sell those rewards within 1 year and make a gain, that sale can also be taxable under the normal private sales rules. Now, moving your crypto from one staking provider to another is generally not a taxable event. When it comes to selling the original crypto that was staked, this was debated for a long time. In the past, many people worried that staking could extend the holding period from 1 year to 10 years because crypto was used to generate an income, similar to real estate. But according to the current guidance from the German Ministry of Finance, staking or lending does not extend the holding period to 10 years for normal currency or payment tokens. So for normal crypto assets, the 1 year holding period remains relevant. The good thing is that in Germany, there is a tax-free allowance for private sales, meaning that sales made within a year, which are subject to tax, have an exemption limit of €999.99 per year. Thankfully, crypto falls under this category, but other sales are also included here. We have talked a lot about profits. Let's talk about losses. But before I continue, please hit the like button if you're getting value from this video and consider subscribing. Alright, please bear in mind the same way profits are tax-free after a year, losses incurred after holding a crypto for more than a year cannot be adjusted, or simply put, if you sell a crypto after holding it for more than a year and you sell it at a loss, you will not be able to claim those losses. So you sold some crypto at a loss within a year of buying it. How can you claim those losses? Well, you can only adjust your crypto losses against profits from private sale transactions under the law. This can include profits from selling other crypto and in some cases other private sale transactions that fall under this category. But what does not fall under this category is your income. So you cannot claim crypto losses against your income from your full-time or part-time jobs. You also cannot claim crypto losses against any capital gains from selling stocks and ETFs. So please keep that in mind. Also, please remember that you have to realize the losses within the year and declare them in your tax return for it to be considered. If you sell the crypto at a loss after a year or forget to declare the loss in your tax declaration, you might not be able to claim those losses. Let's talk about tax filing. If you use Elster for your tax declaration, you can use the Anlage SO. In the current form, cryptocurrencies have their own section called Kryptowerte. This section starts from line 45. Please remember that the exact line numbers can change depending on the tax year. So always check the Anlage SO for the year you are filing. So here you first answer whether you had any income from selling cryptocurrencies. If yes, you tick yeah. Then in the next line, you can describe what you sold. For example, Ethereum, Bitcoin, XRP, or simply Kryptowerte laut gesonderte Ausstellung, which means crypto assets according to a separate attachment. This is important because the official form does not give you enough space to list every single crypto transaction. Most people who have several purchases and sales will need separate tax report or attachment. In that report, you should list your transactions clearly. For example, when you bought which cryptocurrency, how much you bought, the purchase price, when you sold it, the selling price, the fees, and the resulting profit or loss. There is no single official Excel template for everyone. So you can use an Excel file, a crypto tax report, or another clear format that shows the calculations properly. For the dates in the Anlage SO, if you have several transactions, you can usually enter the earliest acquisition date and the latest sale date, and then refer to the separate attachment. But the detailed calculation should still be visible in your supporting report. In the next lines, you enter the total selling price of the relevant transactions, the total acquisition costs, and any related costs such as exchange or transaction fees. Finally, you calculate the profit or loss by subtracting the acquisition costs and the related costs from the selling price. One important point: for crypto, this usually matters only if the sale happened within the 1 year private sale period. If you held the crypto for more than 1 year before selling, the gain is generally tax-free. Obviously, this is pretty complicated, but many web apps help you make the tax reporting file, and if you use a web app like WunderTax, you can have an easier time while filing for your crypto taxes. I have discussed the tax filing process using WunderTax in a separate video. Sometimes the tax office even asks for how you came up with these values in these columns. Here the tax report file would come in handy, as you can simply send this file to the tax office as your proof. You can even send this reporting file along with your tax return if you want to be on the safe side. If you have a really high amount of crypto transactions, you can use special apps to make things easier for you. I'll put my recommendations below the like button. And if you have any recommendations, please share them in the comments as well. One thing I should mention is that many people believe they can get away with not reporting their gains, thinking that their trades were never bought to a bank account, or maybe they did all of their trades on a decentralized exchange, so they cannot be tracked. You must know that the tax office can ask you for proof many years in the past, and in certain cases, especially if tax evasion is suspected, the relevant period can be much longer. The tax office is also developing new technology which can help them track things, especially after the Crypto Asset Reporting Framework, or DAC 8. So if you get into the tax fraud department of the government, things can get very comfortable very quickly. In this video, I share more details on filing crypto taxes in Germany. And in this video, I share what happens if your investment app goes bankrupt.